Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Eric Malka. How you doing today, Eric?
Hey, good. How are you? Thanks for having me.
Yeah, thanks for coming on the show. Well, we're going to dive right in here. So, Eric, tell us a bit about your background before we begin.
Well, I'm an immigrant, entrepreneur. Came to this country in 1985 at the age of 17 with $100 in my pocket, no green card, and barely any education. 24 years later, I sold my company to Procter and Gamble, and my book is based on telling that stories and all the lessons learned. I'm most known for my company called The Art of Shaving, which was established in New York City in 1996, and I exited in 2009. Since then, I've been an investor, both for our family as well in our fund within our industry to support the next generation of entrepreneurs in beauty, wellness, and grooming.
Nice. That's awesome. What caused you to get into the art of shaving? Like why shaving as opposed to any other
Well,
kind
you
of
can tell
business?
from yeah, you can tell from my face.
You sold the
I'm not.
company, now you don't know what to do.
I quit. I quit shaving. I was only 28 when I started the art of shaving, so there was a bit of coincidence. I I took on a job in New York City for a distributor of men's grooming products back in 95. They were importing products from England, including one brand that was in the old-fashioned shaving category. That was my introduction to that. My job sent me to London to work with our main purveyor of products. And there I saw a dozen shops in the Mayfair area that sold old shaving accoutrements and products, as well as offered barber services. I thought it would be a concept that would do well in the United States. Nobody had really done that before. Nobody had brought that in, even though in the UK, it was available for probably the last 200 years. Simultaneously, my wife, who was my girlfriend at the time, was studying natural ingredients, aromatherapy, herbalism, and we kind of put the two together, sold our car, and opened a small store on the Upper East Side of Manhattan called The Art of Shaving. The rest is what unfolds.
Nice. Yeah, it's funny because we used to have that old school stuff in this country, and then it just kind of went out of favor. Everyone's, kind of wants to dislodge the old stuff in favor of the new. But there's been a big trend in shaving and beards, and in terms of consumer, especially online
Yes.
companies that are happening. It's just fascinating to me that those have done so well. What do you attribute that to? Like, why do you think shaving is just kind
Well,
of, especially in the last, I don't know, 5, 10 years, has just kind of come out of nowhere and just kind of dominating the online space?
yes. I attribute that to a couple of things. First of all, Gillette has had a monopoly on shaving. They don't like to use that word, but let's call it a very, very sizable market share. And it got to the point where their blades were being sold for $4 to $6 each. And at the same time, around the time I sold The Art of Shaving in 2009, 2010, there was a huge trend of beards in the US, which was already existing in Europe, but really came to the US. So men started shaving less. You have a couple of companies like the Dollar Shave Club and Harry's that disrupted the blade market with very low pricing. And the result was a lot of successes in that category and a loss of market share for Gillette in the process, about 20 points since then. So I think consumers shifted with the disruptive element of going direct to consumer. Companies in the 2010 to 2018 range started to disrupt the market with going direct to consumer with lower prices, still keeping a healthy margin. Today, it's much more expensive to acquire customers online, so those margins are shrinking, and those direct-to-consumer businesses are a little bit more challenging to start up.
Yeah, why do you think that's happening? Because I know years ago, I've studied a lot of marketing, and I've noticed, years ago when that was kind of happening, it's a big drive. They're very successful. They had some really cool um, viral marketing in some ways. Like some of the stuff was just really interesting. Um, and I'm wondering, like, why is it stopped? Why is it more expensive? And why don't they just raise prices to cover the margins? Like, why is
Well,
that trend changing now?
I think the big shift was when the iOS 14 privacy change in 2021, I believe. That was really the cutoff where before that, you could probably spend $1 and make $4 in sales on Facebook and Instagram. Whereas after 2021, you couldn't track those sales, you couldn't target consumers the same way. And large companies were overspending everyone else. So, I'm not an expert in digital, but from my experience in business, that's what we saw as a shift in 2021.
Okay. What just out of curiosity, I mean, you're still watching the market now. What do you attribute your success to, like with your company compared to where things are now? Because you said you exited in 2009, so that was really before online marketing really took off.
Yeah.
So what do you attribute your success to?
Well, we consider what we did direct to consumer. We had 150 brick and mortar stores around the nation. But what we attribute our success to was um, creating a brand that resonated with the American consumer on a very deep emotional level. We're probably one of the first premium men's grooming brand that did so well in the category. We know that men's grooming is a huge category in mass, but in luxury, we were really the most successful brand out there. And I think we struck a chord with the American consumer. And we what we realized later on is that we had cornered a ritual, a very masculine ritual of shaving. And by creating a four-step system, and it was really the beginning of self-care before that term was ever coined.
Yeah, I mean, I love the fact that you're not looking at it as a product, you're calling it a ritual, which it is, right? Every morning, wake up and you shave. I in favor of this interview, I decided not to shave. So um but honesty, the ritual part I find really fascinating. I've seen one or two other companies really nail it with that market, but they're going for like that high-end market. So like really like one blade, like they're not doing the razor, but it's basically one blade razor, like high quality stuff. I'm just fascinated with it because this has never been a part of my life. It was always disposable. When I started,
Yeah.
my dad had an electric razor,
Hmm.
right? And this is back when I started shaving. It's probably back in the mid 90s. Um, when I started shaving, it was electric razor. Like that's what he did. Like it was like cool to have an electric razor. And I was like, I don't like this shave. So I went to the blades and there were multi blades back. That's when they were starting. They had like two or three blades, and that was cool. And so it's just been interesting to me to see the evolution of that space, and the fact you call it a ritual is even more interesting because it's just brings it back to like just the basics. Um, so
It is the deep. Well, I'm going to use you as an example because when I say we hit an emotional chord with the consumer, um, you just talked about your father. There is nothing more emotional in our lives than to connect with our fathers as men. And we used to see customers right from the beginning of our company come into our stores and talk about my grandfather used to take me to the barbershop, or last time I had a shave was on my wedding day 35 years ago, or I used to see my dad shaving in the bathroom. Those are very, very strong emotional connections to a brand. On the ritual side, um, the importance of that is when we sold the company to P&G, they were amazed at the fanaticism of our customer towards our brand. So they wanted to understand what triggered that so they can replicate it. And after doing research, we thought it was we were making incredible shaving products that delivered the perfect shave. But every customer we spoke to barely talked, yes, great products. They work magically. But all they talked about was that time in the morning when they took 10 minutes out of their day to really pamper themselves and the experience around it. So that's when we realized later on, when we reversed engineered the success, that it was really all about the experience and very little about the product. So the moral of the story is that unless you're really having an emotional relationship with that customer, you're not creating an iconic brand.
Yeah, no, it's funny. It's funny you say that because I had when my oldest started shaving last summer, we went through the process helping him pick stuff out and looking at the different things and starting to kind of like talk him through it. And it's just interesting because I remember like like you said, my experience with my dad, like it was just wasn't an ongoing thing. It was kind of like, yeah, here's what you do and figure it out, like different era. But now it's like it's the same thing. Like they got to make it their own, but like
Yeah.
how do you teach them? So you're right. I hadn't thought of it that way, but there definitely is a very kind of father son kind of thing that happens with that. Like most things, I guess you're going through kind of like your transition points in life and learning certain things as you grow up in age. Interesting. Um so tell me a little bit about your journey. So you started this company. Um, how did you continue to grow it? Like what allowed
Well,
you to continue to grow it, and where'd you go for inspiration for growing this when you were, I think, probably the first in the space to do it?
well, our first store did fairly well. And 6 months into it, the New York Times wrote a two-page article about our shop in New York City, and the business blew up overnight. We were generating a month's worth of business in every single day after the article came out. And that gave us the resources to open a shop on Madison Avenue with full-time barber services. And that shop did extremely well. So 2 years into starting this company, we were generating over $750,000 worth of profits on a yearly basis. And that gave us the resources to create our own brand of products to sell in our own stores. And that turned our little mom and pop company into a branded consumer brand. And that was a game changer. Neiman Marcus came calling almost immediately. They saw an article about our company. We started doing business with them. We started selling to all the department stores. And next thing you know, a few years down the road, we raised a little bit of capital and started to open stores around the country. So if you think about it, we went from a kitchen table to a strategic acquisition with a Fortune 25 company in 12 and a half years, which is not a whole lot of time. I know some people do better than that, but when you think about it, kitchen table to P&G in 12 years is a pretty nice ride. So we grew very, very rapidly, even though as a young entrepreneur, I felt it was going a little slow for my taste. With some wisdom now, I look back on it and realize that we scaled very fast. And we did that by a combination of pivoting. We pivoted when it was the right time to pivot. I remember 9/11 was one of those pivots when we were thinking about opening shops in the other side of the world, the country, 9/11 happened, and I thought, I don't want to live on an airplane, and I don't have the money to open all these stores. Maybe I should focus on my wholesale business. And that was an incredible timing because the metrosexual movement had just started to hit the hallways of all the retailers around the nation. So we were perfectly positioned for that. We opened over 800 doors in 2.5 years. And that gave us the brand awareness and the momentum to raise capital at a decent valuation. And then we pivoted back to opening smaller formats in prestige malls around the country. From there, we did a deal with P&G to become the first Gillette licensee in the history of the brand, and we own the Gillette brand for the upscale market. We launched a co-branded venture with Gillette that did really well, and that led them to ask us to sell them our brand, which we did.
Nice. So, all right. So you went through a lot there. So at what point, as you're making, you said 750,000 profit a year, you started creating your own products. When did you decide taking on capital was the right choice?
It really it took a long time. We raised capital in 2005. We started the company in 96. And we really waited until we needed the capital. We understood what we would do with that capital, and we wouldn't dilute ourselves completely by bringing capital too early. So it took 9 years before we took our first capital, and 3.5 years later. By the way, we took our first capital in 2005. That was $2.5 million friends and family round that with local businessmen. In 2007, we raised $15 million with a private equity shop in Boston. And in early 2009, we were acquired. So it was the final ramp up was really rocket fuel to get us to the finish line. And that's one of the principles I teach entrepreneurs is to really crawl before you walk and walk before you run. And when you're ready to fly, get that rocket fuel and blast off. But a lot of entrepreneurs, I think, blast off before they're ready, and that can be a real pitfall for many businessmen.
So if a business is looking to take on capital, I know there's things like multiples and, you've got profits and cash flow and all that. Like how are businesses or private equity or venture capital, like how are they looking at a business like yours in terms of valuation? Like, what do you feel is like the right way to consider that as a business owner?
Well, we're in the beauty industry and we're a branded consumer good company. And, you know, we're traded on a multiple of sales usually versus a multiple of EBITDA. And currently, in our industry, the average is about 5 times revenue for investors to come in. We've seen transactions with strategic acquirer as high as 10 times revenue. So it's a very lucrative category, but very few get there. It's no barrier to entry, but it's a fierce competition to get to the finish line. So it's really the survival of the fittest out there.
Well, how do you deal with the fierceness of the competition? I mean, you're out there. It sounds like you were one of the first in the category, and there's an advantage to being first, right? It's like I think of it as like the Joe Rogan concept, right? There's only one Joe Rogan, right? I don't know if he was actually first, but he was one of the first in there. You can't become Joe Rogan now. Like it's impossible because it's too late. It's too saturated. Yes, you could become popular. There are people who do it, but no one's going to take that spot because he's been there so long and the experience and all that. And I see this hold true with different mediums as well. I've seen it over time. Like the first one tends to be, it's hard to unseat if they do a good
Well,
job when they're first.
I don't know if it's the first one or the first one that breaks out, right?
Yeah, right.
Like Starbucks wasn't the first espresso shop, but Blockbuster wasn't the first. Well, that's an antiquated example, but we know that the is the first one to break out, not the first one in market. Um, I would say that in our case, my philosophy is that execution is everything. I don't find a problem walking into an industry that is highly competitive or saturated if I know I can execute better than anyone else in that category. Because ideas are not, the art of shaving was not a brilliant idea, although I'm always complimented on how incredible the idea was. It wasn't a very incredible idea. I saw these shops in London. I thought it would do well here. The idea was pretty simple, but how we executed the idea, how we implemented every element of the brand was really the magic of our success. And I've seen a lot of people try to emulate the art of shaving over the years, and they never executed it as well as we did. One example is we rented expensive real estate on Madison Avenue to sell shaving cream. Most of our competitors tried to go for lower rents where foot traffic was non-existent. So we always tried to execute and push the envelope of luxury, customer service, company culture, packaging, branding, marketing, experiential retail to the best of our ability. And I think our talents allowed us and our good instincts allowed us to execute better than the next guy.
Yeah, no, I appreciate that. It sounds like you have to be really good at managing people if you're trying to convey all of that to your people, where they are also um, conveying that experiential moment, right? Because this is if you're if you're renting space in Madison Ave, obviously you've got to really deliver.
Yeah, that's one of the things we're most proud of is the culture we built. You can't create an iconic brand and you're not going to be highly successful unless you create an incredible culture in your company. And many times we were told our managers and our staff were confused for owners um, because they really cared and so passionate about the company. And I think that was one of the magic sauce for us. And it was hard to manage people, by the way. I consider that to be 90% of our work. Constantly, I had 3 to 5 people teams all spread out all over the country that had to open the store on time, keep it well stocked, greet customers, generate revenues day in, day out, every day. So if you're not managing them tightly and creating processes, structure, carrots and sticks and so forth, it's not happening.
So it brings up a good point. I mean, there's obviously the human element to this. I mean, you talk about the brand and that's all great, but consumer goods is obviously competitive, but I would imagine it's also very complicated because you've got the people in the experience, you got the supply chain, right? You got all these different components. Like a service business is easy. I show up, I deliver a service. But you got goods, you got to figure out where you're buying it from the supplier, like how are you getting it shipped? Like you've got
Yep.
all these different pieces. How did
Yeah.
you how did you get really good at all those pieces? Like, did you have people like helping you, or like what?
I,
How did you figure it all out?
I was really good at the finance and operational side of it and sales leadership. So that was really helpful. I found that I was able to do most of the functions pretty well. Eventually, when I hired a management team, each of them did one part of my work much better than I ever did, but I was able to do it well enough and do all of them well enough. On the other side, the stuff I didn't do well at all, the creative stuff, the the marketing, my wife was really filling that spot with great talents. So we were very complementary. I used to do my purchase orders between helping customers in the first year, but consumer good companies, you have to manage your inventory super, super well. I mean, that could make or break you. I envy the service industry because managing inventory is tough. If you buy too much, if you buy too little, it's just, it helps to be, when I started my career, I was in clothing and we had sizes and seasonalities. When I transitioned to beauty and grooming, it was a walk in the park for me, inventory that has a shelf life of 3 years that has no seasonality. To me, it was like, are you kidding? This is like a walk in the park here.
Yeah. Yeah, that's yeah, it's interesting. Um so let's talk about, your exit. So obviously you had a successful exit to P&G. Um how did that process work? Like how did you decide that you were ready to exit and, what were you considering throughout that process?
Well, I was planning my exit since 2002. So I interviewed a CFO to come work for us, and she asked me, "What's your goal?" And I said, "I want to exit by that date range within that amount." And she knew that I was serious about it because I had thought about it clearly, and we hit it right into that sweet spot. The process was very simple. When we started the licensing deal with Gillette and P&G, we knew that we were kind of in the spider web, right? If the joint venture was not successful, it would leave me in a weird position. If the joint venture was successful, it would lead to an acquisition, most likely, and I would have less leverage in that process, which is what happened. P&G, being a very nice company to work with, played a fair game. Unfortunately, our bankers really dragged their feet on the transaction, and by the time we got the deal into due diligence, Lehman Brothers collapsed along with it, the stock market in October 2008. Um, you can imagine my position when P&G executives fold all their work and are being asked to go back to Cincinnati or Boston. The deal is off the table. Prestige retail sales are down 25% in Q4. Our cash flow situation is in a mess, and we're really facing insolvency going into 2009. I'm talking to investment bankers and bankruptcy lawyers at that moment. So stress is pretty high. We go into crisis management mode with our business. We default on all our leases. We're not paying our investors their interest. We're letting go a few people because we were running a tight ship. We stop all capex. We reduce our inventory level, and we survive the next 4 months until we get the deal back on track and finally close a transaction that was retraded a little bit by May 31st. Through that process, we probably lost 20, $30 million in the transaction, but we still came out well. More is not always more, as you know. It's always nice to think about it, but
Yeah, what are you going to do with more? What's the old quote from the movie Wall Street? How many how many yachts do you have to water ski behind to, like more is just it's just a number, I
you can't
guess.
water ski behind a huge yacht.
Yeah, that's true. That's true. It's kind of a bad analogy, but I didn't do
No, no, it's
it.
a good one. It's a good one.
Um,
So it was still a good deal. I'm grateful for what we were able to achieve. Unfortunately, the crisis came at a bad. It was the first time we had bad timing, but it all worked out.
well, good. So, obviously, exiting kind of changes things for you. So it's great that you were able to close a transaction, which, sounded like if you didn't, it'd be really tough otherwise. But how do you like, I always think about your business like your baby. Like, how do you sell your baby, right? Like, you can't sell your baby. So what do you do? Like, how do you think
I
about
would never sell my babies,
exactly?
but that wasn't my baby. That was a means to an end. I mean, I don't want to be sounding, I don't think I try not to be emotional about things. Like I love my home and I don't want to sell it, but it's just a home. It's just a brick structure, right? My business was a means to an end. I knew that financial freedom uh, was only available to me by selling the brand. It was never going to generate enough cash under my wings to support the lifestyle I wanted, the freedom I wanted, really. I had been working since I was 16 years old, and P&G was offering me an incredible amount of money for the brand that was actually having negative EBITDA during our negotiations. So it was a pretty easy decision. It was a hard transaction to work on because of the financial crisis. And then we had an earnout. So when I signed the deal, the clock was still ticking. I didn't get all my money until I delivered some bacon for about 2 years after the transaction. And we were able to deliver and achieve 100% of our earnout, which was, really fortunate. Otherwise, I would have been crying on this podcast instead of, saying how good things are. So I have a lot of stories to tell around the campfires, if you will.
So let's talk about that because you sell the business and it must be gratifying to get the deal done, but then you got to stick around after and keep working on the business. So what's that like? Like, how did you kind of negotiate what was right for the deal, and then like what was it like afterwards? Is maybe kind of like anticlimactic because you still got to come back to work and all that.
Yeah, well, I think it was 2 weeks before closing the transaction that P&G executives found out that Bank of America was foreclosing on our $3 million line of credit and that we were probably insolvent at that point. So they took advantage of it by making about 40% of our transaction an earnout and giving me a strong incentive to stay on for 2 years and help transition the brand to their teams. At first, I hated the idea. It was an additional risk. There was no guarantee I was going to get the earnout. But then, after I started working with P&G, I realized what a great opportunity it was for me to learn from that amazing company that is renowned for marketing and branding, to really round out my skill sets as an entrepreneur. Um, and for me, it was a unique opportunity. I was sitting in on meetings with the top 20 executives at P&G's men's grooming. And a guy like me that never went to college would never aspire to be in that room. And what I've learned during those 2 years was nothing short of amazing. It was a great school. It was like having a master's degree in entrepreneurial business. Um, and fortunately, we were able to deliver. We had a target of 22% over an 18-month period, top line revenue growth, and we delivered 35%. So another thing I realized is that without all the stress that is on the CEO founder's shoulder, I did the best work I had ever done because now you remove all these elements off my shoulders and you ask me to just do what I do best. And I was able to perform. I use an analogy like before the acquisition, I felt like I was swimming with a metal armor. And after the acquisition, they asked me to swim in a Speedo. So for me, it was a great experience. It was a learning experience. And fortunately, we came out on the other side with a great relationship with P&G and a full earnout, which we had 82% equity of. So it was really meaningful to us.
Nice. So, um, so once that was over, and now you're kind of disconnected from the company and you're doing other things. How did you look at that next step?
Well, I'm a planner, and I had planned to have kids with my wife after we sell the business. But because the acquisition took a little longer, my first son was 3 months old when we sold the business, and our second son was born 3 days after we left the company after the earnout. So I wake up the next day and I'm like, all right, what am I going to do with my life? And I realized that I've always wanted to be a very hands-on father. I had two babies in the other room, a pile of money, and a really anxiety-filled mindset, from the ride. So those became my three priorities, be a hands-on father, uh, embark on a self-realizing journey of wellness, both emotional, spiritual, and physical, and really figure out how to manage our assets going forward as an untrained investor. So learning to become an investor became my full-time job at that point. And those were my three priorities, and they still probably are the same three priorities today.
Yeah, I always find it interesting how you go from growth, like a lot of people, they grow their business, then they sell it. They go from growth to, I don't want to call it maintenance, but preservation, right? Like you go, like it's a different skill set. Like the entrepreneur's
Completely.
skill set is about growth, and then you get to investor. It's a completely different skill set, and people succeed. It's hard for people to succeed at both because they're
Very
they're almost
hard.
opposites in some ways.
The biggest mistake is that people don't realize it's different. And they continue being an entrepreneur after the exit, and that is can be a very, very costly mistake. In my case, I realized that I had no clue what to do with the money. And I talk about this in my book. My job was to learn the art of investing, right? And I realized that the mindset of an investor is almost opposite of an entrepreneur's mindset. You really have to be patient, and you really have to think long term as an investor versus being an entrepreneur that tends to be more on the fly. I think when we become more seasoned as an entrepreneur, we start thinking more long term. But in most cases, we're tactical, right? We're on the terrain, just blocking and tackling and growing. So that was a transition for me to go from being an entrepreneur to being an investor.
Yeah. So tell us a little bit about that journey of being an investor. So you have this pile of money, you have to figure out what to do with it. How do you determine what to do with it? There's so many choices. So how did you go about that?
There are many choices, but when you really think about it, and by the way, I went to learn from the best in the business. They have to know something that I need to find out. So I read books from Graham to, all the great investors of our time. I attended school at the University of Chicago. I took Harvard business classes. I just dived into learning as much as I could. And the message was pretty much the same across the board. There are not that many asset classes to invest in. So you need to know what kind of investor you are. In my case, I wanted to be a passive investor. And as a passive investor, your real choices are the financial markets, private equity, and probably real estate. And those are your choices. So for me, it was about creating a diversified portfolio that was low cost and tax efficient, and taking about 10% of my assets to what I call play money to really go after much riskier transactions that could have a much bigger upside. So the relationship between risk and reward is one of the first things we need to learn about as an investor, how to manage risk and reward. What is our appetite for risk and how does it relate to reward? So 90% of my assets are low risk. You know, if they generate 7, 8% annually, I'm a happy guy. But I have 10% that I play with. I invest in small companies in my space through strategic brand investments. I roll up my sleeves and provide strategic guidance to our founders. And there could be a huge reward along with a huge risk, but I'm risking a small amount of our capital. So managing that risk is very important. And every investor is different, by the way. So I'm just talking about my take on it.
So do you consider your investing in the small companies more of as trying to be an investor, or do you see it more as kind of giving back and supporting, the community?
Both, both. I really feel a strong sense to give back and to support the next generation of entrepreneurs. Actually, we just closed today on a company that is based in Miami Beach, and we're based in Miami Beach. So it goes even beyond our philosophy of supporting entrepreneurs in our community. One of the founder lives about a mile and a half from my house. So that feels really good to help and to support. And the reason why I call it more giving back than investing is because the nature of it is high risk. And the leading, when I look at my hedgehog concept, the Jim Collins hedgehog, the three circles are I wanted to do something that was fulfilling, which is that part of giving back and helping entrepreneurs. The fun, I want to have fun working. And that is by choosing entrepreneurs that I enjoy being around. And the third part is financial, and it is the third part, it is not the first part. And that's a huge, important way to classify those elements. I would like to make a lot of money off of these investments because I want to have a huge impact on these founders. But that's not the driving factor. For the first time in my career, making money is not the number one criteria.
So one one thing that kind of comes to mind here, how are you finding these new ventures? Because I know in Boston we have a very strong angel community. There's like three places in the country that have very strong angel communities. And Boston is one of, if not, it's the top three. I don't know if it's number one or two, but it's definitely top three. Silicon Valley, I think there's another one in Texas. Um, so how do you find enough companies to review, or how do they find you? Because I imagine with your exit, people want to work with you, but how do you locate enough deals to go through them and find the right ones?
Well, we're pretty well known within our industry. First of all, it starts with having a very narrow lane and finding your niche. I think as an angel, you need to find your niche. Being a big fish in a small pond is the way to go for a guy like me, at least. And our niche is luxury beauty and grooming early stage companies that are too small for the VCs in our space. So you have to get to $5 million to be really viable for the starting point VCs in beauty. We look for companies that have proven market fit at about $1 million. Usually they are lacking in expertise more than in resources. And we cast a wide net within our industry. It's a small village. The beauty industry is really a small village. that we've been a part of for 30 years. We have a great reputation with the Art of Shaving exit and brand, and basically a lot of networking. In the past 3 months, we've had 26 companies submit their brand for us. From that, we've only done one transaction, and we do, I've become the brand. For the first time in my career, I'm no longer promoting a product that is a physical product. The product is myself and my wife. We do a lot of social media, which attracts deal flow. I speak in front of audiences. I'm speaking at MIT in June. I spoke at universities locally to entrepreneurs. I speak to entrepreneur organizations. I do a lot of podcasts. It's just like promoting a product. You put yourself out there, you do marketing, and you attend industry events. You let the world know what you do, your value proposition resonates, and people are referred to you or come to you directly. That's what is happening. But we're not looking to do 1,000 deals a year either. We're very, very picky. This year, we're not going to do more than 2 to 3 transactions because we also get involved with each of those. We don't just write checks and weigh, what they call spray and pray. We really roll up our sleeves and try to have a disproportional impact on the company's success through our efforts.
Yeah, and so one last question as we wrap it up here. How do you think of the concept of legacy? I mean, you have this pile of money that you have, family you're focusing on a lot of things we talked about. But now that you're in preservation mode, like, how do you think of the concept of legacy? Like, 'cause you got next generation and you have enough wealth that can be both a good and a bad thing.
It could be. It could be. That's a tricky one. Raising children, as you already know, is you know, that's a little bit more complicated because everybody's different. I have 2 sons and they couldn't be more different. So how do I, how I think about it for each of them is challenging. But when I think about legacy, which is something I've been thinking about as I age, um, our family's legacy is probably based on two areas. One is our cause of promoting natural health and low toxicity is really important to our family's brand DNA, if you will. And the other one is the entrepreneurial spirit of our family. And I think our kids are naturally becoming very entrepreneurial by association with my wife and I and everything they've seen since they were born. I'd love to be remembered as someone that really had an impact on the entrepreneurial community and really gave back to help the underdog. I consider myself to have been an underdog that won at the end. Very few people are able to do that. And if I can have a positive impact on some or many of them, I would leave this earth a very fulfilled and happy guy.
Awesome. Well, Eric, I really appreciate you sharing your journey with us. Where can people find more about you?
EricMalka.com or strategicbrandinvestments.com are the best ways to get to me.
Awesome. Well, I appreciate you coming to the show. Recommend listeners reach out. I know you have a great book, and yeah, thanks for sharing your wisdom with us, and wish you luck in the future.
Thank you, Kirk. Thanks for having me.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Eric. I really appreciate him coming on the show. Now we're into the panel portion of the show where we have our own Phil Weiss. Hey, Phil.
Hey, Kirk. How you doing today?
I'm doing great. I'm doing great. I'd rather be outside on a bike in a day like today. It's a perfect day, and because of a schedule snafu, Barb couldn't join us, and that's my fault, not hers. So, it'll just be me and Phil today, just chewing the fat. So, Phil, what were some of your takeaways from the interview?
So there are a couple things that I thought was interesting. I mean, I enjoyed when you and Eric talked about like starting to shave and those type of stories because I have three of my four kids are boys, so I remember when we went through that with them. I even thought back to when I first shaved. But I remember the Shave Club which I believe is the business that he sold to Procter and Gamble, where he used to go in and like order. I never did it, but you would go and order like a month's supply and that kind of thing. And it's kind of one of the things I thought was interesting when you talked about giving up your baby and how hard that was. And he's like, no, that wasn't what this was at all. That was hard for me to get as like somebody who's built their own business. I had a tough time thinking about that not being my baby, right? To start something from scratch and build it into something. That was a little surprising to me. I appreciated too, like his learning more about investing and going, reading Graham and going to University of Chicago and things like that. I thought that was pretty interesting. And then him talking about being interested or favoring passive investing, but yet he's doing private equity things. And like that seemed like a little bit of a contradiction to me.
Yeah, we can definitely get into that. Let's start with the baby thing. So, what I find interesting is I do this exercise periodically. Not on any sort of scale, but I periodically will do this exercise. And the exercise is um, selling my business today, right? Like I'm going to sell my business today. What does that look like? And I don't do it because I'm serious about it. I do it because the process of thinking about it allows me to disconnect from the emotion, right? Or realize where the emotion's coming from, right? And it's not a good or a bad thing. It's more of like a mindfulness exercise, like putting yourself in these positions. So for me, I might say, how am I feeling today? Well, I feel like I could take it or leave it. Okay, well, where's that coming from, right? And figure out like where that's coming from. Maybe it's because of a frustrating week. Maybe it's because things just can't be solved. Maybe it's because I'm done. Like, whatever. The 50 million reasons, right? Or maybe it's like I'm definitely not selling because I gotta, get over this next hill first, right? Or whatever it is. But just knowing how you feel about it's really important. And I look at it similarly to like I look at investing, right? So when you're investing, you should do the same thing at least once a year. You should look at your portfolio and say, what are we going to triage here? It's like a portfolio analysis every year. Look through the positions. Would I buy this today? If the answer is no, it's done. It's out. If the answer is maybe, then I have to consider, do I want to keep it or what, or why is it a maybe? And if it's a absolute yes, to be like, oh, do I have a big enough position? So you thinking from a different perspective helps you analyze your decisions differently. Because I'm just looking at it, I'm like, I don't want to sell it because it's down, it's going to come back. But if I look at it in a snapshot and be like, I definitely would not buy this today, okay, then I should just sell it, right? It brings a different lens. It's like bringing Phil over to my house and be like, Phil, what do you think I should do with this position? And Phil's like, I think it stinks. And be like, all right, get rid of it, right? It's just a different perspective on something I'm struggling with. So you do that with your portfolio. Why wouldn't you do it with private investments? Well, the reason is because a private investment is a little bit more than just an investment. If you're a business owner, it's your baby. You did it, right? You built this thing. You created it from scratch. You started with nothing and with your bare, with your two hands and I did this, like all that stuff that comes with being a business owner, right? Or a craftsman. A lot of business owners are craftsmen. Like not in the traditional sense of the word, but like, an accountant, an attorney, an advisor. Like we're craftsmen. We're professionals with this certain set of skills that we're really good at. Like a doctor who's a surgeon, they're really good at surgery. Now, um, does that mean the doctor, the surgeon, is a good business owner? No, frequently it doesn't. The same thing with like attorneys and accountants and advisors. Usually they're terrible business owners, but they're really good at that thing. So the difference being in a business owner is you have to have a whole nother set of skills. Or most people, like they get in because they're craftsmen, but they have to learn the set of skills to be successful. Because if you're Warren Buffett and no one knows who you are, then you're not going to make any money, no matter how good you are, right? People have to find you. You have to learn how to market yourself. You learn how to connect with people, all the business skills. So when I see stuff like this, people who are successful and like grind it out, like I love that. I just met a guy who has like 100 businesses still. Like he has them. He just goes and acquires them and he just puts in frameworks and goes and buys more. It's like an addict. Um, and that's cool. Like if that's what you like to do, right? If you're just like basically making a machine and just making things run and all this, that's cool if you can do that. Like, and I'm sure there's a lot of money to be made. I don't know that I enjoy all those processes, but it's an interesting idea. So when you think about, private businesses, a little different from public in that there's more tied up, there's more risk, right? You can't just get out. Can't say, "Oh God, that was stupid. I shouldn't have bought this business." Get out. No, you're stuck. Unless you can find someone else to hold the hot potato, you're done. So there's a little bit more that has to be done, and there's usually a little bit more emotion tied in, right? Because it feels like it's yours. It's like this is mine. It's like buying a piece of real estate. I own this. This is my land. I want to put a flag in it. This is Kirk's land. Like it's the same kind of feeling, like sense of ownership. So I don't know that I feel that about Microsoft or Apple or Johnson Johnson. Like this is mine. Not really. It's kind of mine temporarily until I give it to somebody else. It's like I think there's a little bit of a difference there. I don't know how you feel, Phil, but that's kind of how I feel about it.
I agree with a lot of that. I get there's one other thing that I'll add though that I think of from the time that I started my business because I was an analyst before I had my business. And I said to myself, if I'm running a business, I want to run my business in a way that I would want to invest in it as an investor. Like I want to make those kind of decisions. I don't want to make short-term decisions. I want to make decisions that I think are going to be beneficial for the long term. And I think that to me, that was really important. I do think too that, like I view it, there's a sense of pride that comes with starting a business from scratch and building it up into something. And I definitely feel that. And that's the part to me, like when you say it's not your baby, it's hard for me to get there. And you're right, it is different. Like, for example, I was going through some client portfolios today and I exited a couple positions. And one of the clients, this is client for whom I manage individual stocks. And one of the clients asked me to always send him an explanation, just a brief thing so he can understand why I do what I do. And one of the stocks that I got rid of, it's like one of those things where I looked at, I said, I don't think the story is the same as it was when I bought it. It is actually at a loss. And unlike most people, I think I'm more comfortable recognizing losses than I am holding on to the gains. I'm okay with saying I made a mistake. And that was what it was. I looked at it and said, I think I made a mistake. It's not the business that I thought it was. Like you said, if I had to look at it today, would I buy this business? And the answer is absolutely not. So it's easy, but that's an easier decision to make when it's not your business. And in a lot of ways, it's not just because it's only, in this case, putting in a buy or sell order. You can't sell a private business that way. But there's also not that same attachment. Yeah, there's stocks that I've owned for a really long time that I may not sell, but it's still not the same feeling that comes when you own the business. It's just, they're very different things to me.
Yeah, it's interesting. I mean, let's talk about the comment you made also for passive investing versus passive plus private. I mean, I thought Eric's perspective on running a business was great. I appreciate his. I love the stories and all the stuff he went through. I mean, sounds crazy. I mean, I love these business owner stories. They're just so cool. Um, yeah, and he's a better man than I if he can disconnect his emotion from selling the business, because that's really, the best in business. The best investors are people who are uh, emotionally disconnected from their investments. They look at it as a true investment, not as their baby. Personally, I don't think I could do that. I mean, I can do it public investing, and I can do it with other people's money. I can't do it with my personal business. Like I feel like it's me, and I shouldn't. Like in the ideal world, what you want to do in a business is you start it up, you start hiring people, you build systems and all this, and eventually you disconnect your personality or your brand, your personal brand from the business, and the business continues to grow without you. That is ultimately the best way to run a business, because if I ever need to sell it, I can't, because it's all about me. So it makes it hard to sell. So the ideal, and I've learned this over the years from other business owners, that there's some really good books on this, on disconnecting your personal self from the business, so that when somebody buys it, they're just buying like a machine that's working, as opposed to a person who needs to be there. Because if I'm selling, I don't want to be around. I want to sell and move on. And by the way, for those of you listening, I'm definitely not selling my business, but I just want to be clear. Just using this as an example, but I think that what's interesting is he said he's a passive investor, but then he invests in these private things. So I don't know. What are your thoughts on that, Phil?
So I guess there's a couple different ways that I could look at that. Generally, I think if you're a passive investor, you're a passive investor and you can do that. But there are strategies along the lines of indexing plus a few. That's what a friend of mine used to call it, where the bulk of our portfolio is going to be an index, and then we're going to look for some investments that we really like. Maybe not private equity, because that's not something that the average person can access as easily, but we're going to look for some other things that we might want to put in the portfolio just to make it a little bit different, hopefully to benefit returns. But of course, we can't always pick the right, make the best investment decision. Not everything's going to work out. Um, if if I'm thinking about it too, like if you say I'm going to take 5% of my portfolio, like for the average person that doesn't have the same kind of capital as I would assume Eric does after selling his business, to say I'm going to take 5% of my capital and I'm going to put it into something that's more speculative, that type of thing, knowing that it could go to zero, that can be okay as long as you just don't overdo it. But for the average person, I think it's kind of tough to say I'm going to be a passive investor, but then I'm going to go into private equity. Like that's not common, but I guess you could also look at it that the passive investing portion of my portfolio, like that's really my base. And as long as I know I have that, I can go and do these other things because I have the time, I have the interest, I have the knowledge to go and find something. So I think if you're in Eric's situation, it probably makes more sense. It's not probably, it definitely makes more sense for somebody like that to do that than for the average person.
Yeah, it's I find it to be interesting, because Boston's filled with a lot of angel investors, and those of you who don't know what angel investors are, they're pretty much like pre-VC. So if you think of, there's like me starting up in my garage, right? Just with my own money, family, just my money. And then I reach out to family and friends. And then I'm looking to grow. I'm like run out of family and friends who want to give me money. So I got to go to somebody else. Well, I'm not big enough for a venture capitalist, but I'm big enough for somebody who sees the vision. So they have these angel investors. It's like smaller than VC, but bigger than just starting up in your garage. Although it could be, the angels will invest in that. And I've talked to a lot of them because they have a really deep angel network in Boston. I think Boston and Dallas and San Fran are like the three big hubs in the U.S. And Boston, I think, is one of the biggest. I mean, San Fran might be biggest because of the tech industry, but Boston's like really close. Like it's huge. And what I find interesting is in Boston, I've talked to a bunch of them because I went to a bunch of the meetings and chatted with them, and they really kind of shared insights into how to be a good angel investor. And they're like, well, basically, I had my exit. I made a bazillion dollars in my exit, and I needed something to do. I needed a hobby. So I just invest like 25 to 50K in like up to 10 different angel investments. And it's my way of giving back to helping other investors. And also it's fun. I get to like, contribute and be a part of stuff. So, you know, to me, stuff like that, it's like, okay, like it's really just a hobby.
Mhm.
Which is perfectly fine, right? If you have enough money and you need to keep yourself busy, it's a good hobby. Like, hey, I'm really good at this stuff. I had a lot of success. Let me show you what I did, so you can be successful too. I would take your money and do that just so I can learn from you. That's awesome. Um, you know, I think the challenge is, as you said, is like, what are you really trying to accomplish? If you're doing it with 5%, well, I think that's an interesting debate because you're like, all right, I got $100 million. I need, if I put 5% into investments, so I take $5 million and I put it into like these private investments. Um, if my portfolio goes up a little bit more than 5%, I just filled that gap. So even if all my investments go to zero in the private side, my portfolio is up 10%. So now, that 95 went up 10%. So that's what it's approximately 110, a little bit less. But it's 110. So that five is missing. Who cares, right? Or 105 actually. Sorry. I'm just doing math in my head. To 105. So you pretty much just made 5%, and that 5% that you potentially could go to zero, who cares? You made 5%, and so when you think of it in the grand scope of a portfolio, doing these small little risky ventures are not bad as long as that's not your whole portfolio, right? Like I had a guy once and it was really too bad. He came to me and he's like, I want to put 100% of my IRA into gold. I was like, well, I don't think that's a good idea. Like I understand where you're coming from. And I appreciate it because I feel the same way, but it would be irresponsible of me to recommend that. So what happened? He went and go found someone who said okay, and they did that, and now he's got some guy, some coin dealer who has his own custodian. He's keeping the gold for him, and he's got all his money in this guy's custodian. I'm like, does this custodian really exist? And I told him, I said, let me check this out for you at least. Like, give me 5 minutes, I'll check it out. So I called the custodian. Nobody picked up. Nobody ever called me back. Oh boy, good luck to you, man. I hope you don't lose all your money, but that's what it looks like to me. And he's like, well, I feel like this is the direction. I'm like, hey, to teach their own. But that happens, right? People get passionate about something and they get tied to it, and then at the end of the day, it sometimes it doesn't work out because you're too emotional about it. You're too passionate about the thing, and you have to be disconnected. So I don't
Yeah,
know.
that was, and getting back to it, like, that's the interesting thing about Eric, right? He says it's it wasn't his baby. He doesn't have that emotion. It seems hard, but I get it. And the other thing, when you talk about that idea, you had that $5 million, and if you're making angel investments, you put what if you put $100,000 in, that's 50 investments in theory that you could make. And if I think back, there was an old book called The Gorilla Game. And the Gorilla Game was like where you invest in a basket. And in this case, it could be investing in a basket of startups. And if one of those hits, you're not, that 5% is going to become even bigger, right? Because those investments, when you make those type of investments, if you're fortunate enough to have success in just one, you can get all your money back easily and more.
Yeah, I think the metrics that because I've talked to a few VCs. I used to work in an office building where down the hall was a venture capital firm. So I just go down there and hang out with the guys once in a while. I mean, they're pretty easygoing guys. And So I go down there and I talk to one of them, grab lunch with them, and it's like, so how do you run your portfolios? He's like, well, it's easy. He's like, I buy 10 companies. One's a grand slam, like one's a over the moon, multi-bagger, 20-bagger, 50-bagger, 100-bagger. Um, Probably about three, 3 to 4 about three of them go to zero. About three of them are a neutral, meaning they don't really go anywhere. They don't go, they're not bad, they're not good. They just kind of like, tread water. And three are like singles and doubles. So if you kind of add it all up, really what it comes out to is about a 20 to 30% a year return, with some speed bumps, right? 2008 to 2013, I think it was. It was a rough patch where all these VCs were not investing in new companies. They were just basically filling the gaps for existing ones and making sure they stayed afloat. Um, but like, but when you think about it, like you're really looking for that grand slam plus the singles and doubles. The problem is you don't really know, right? You put all this money in, you do all the work, and you're like, let's roll the dice. Right? You don't know. Like stuff can happen. Look at COVID. I mean, one of my friends that I used to spend a lot more time with. He's an advisor, and right before COVID, he was signed up to do seminars. He had paid like 12 grand to do a bunch of to like do 2 seminars, and he had paid this company the money, and the seminar basically was happening in like March 10th, or I don't know. It was like a week after COVID. So he spent all this money to fill the room, and then COVID happened. Of course, no one's going to show up. All that money was lit on fire. That was his marketing budget for the entire year. Like he was just starting out, and it was his entire marketing budget. It killed him. I don't know if he's still in the business. I haven't talked to him in a while, but like, but I've talked to a lot of businesses. They're like, yeah, we bought this thing, and then COVID happened, and the whole business imploded. Like, you don't, things happen. It's not your fault, and it could be a great business, but because unfortunate events happen, you just gotta, you gotta figure out what to do and move on. So I I find, that's kind of challenging, but I guess you have to be a business owner to really want to do that. Like it's not for everybody, like I'm an entrepreneur. It's just how I'm wired. I could never work from. I saw this group of entrepreneurs that I went to a conference once, and they have this shirt called Unemployable. It just says unemployable, which I thought was great. I'm like, where did you get that shirt? I need that. I am unemployable. Um, and so, some people are just wired that way. Like when I first started working, I'm like gritting my teeth. I'm like, I can't wait to get out of here. I can't wait to get out of here. I can't wait to get out of here. Like when I was first out of college, I'm like, I just gotta build these skills so I can go do my own thing because I'm not happy working for somebody else. And a lot of people are like that. And there are a lot of people who love that. They love working for people. Like my wife loves working for a big corporation. It's great. And I'm glad that she's happy. She could never do what I do, and I can never do what she does. Like we're just wired differently. And so I think a lot of people, and I think there's this middle ground of what I didn't come up with this name, but I call wantrepreneurs. They're people who want to start a business, but can never get past the um self-flagellation stage. Like, that's probably the wrong word. I don't want to use it, but it's it's like business porn. It's like, oh, I can't wait to start a business. I can't wait to learn this. I can't wait to do this. And it's like, but they never actually do it because it's like a dopamine hit to come up with all these ideas. But the hard part is to actually do it. And it's like, oh, it's gonna be too hard to do this. Let me just come up with another idea because that's fun. I feel great. It's like dopamine, dopamine, dopamine. It's just like, let me hang around other people who are doing the same thing. Dopamine, dopamine. It's just like, so I don't know. I, it's a hard thing to do. A lot of business owners fail. It's getting harder. I there's one frame that I like to think about, and then we'll move on to another topic. Um, I read about, what was this? I think it was on a podcast about a year ago, and they were talking about ants. And if you observe an ant swarm, like drop a piece of candy on the ground, come back in 3 or 4 hours, swarmed with ants. Now, there's a piece of candy swarmed with ants. All the ants know it's there, right? They're just waiting for their piece so they can bring it back to the colony, right? And then you see the line, to the hole. Think the hole comes out of nowhere. Like, how do they know this? Like, what did they just got a speed pass or I don't know. But anyway, so there's a new hole next to the thing where they take it down. But then you see these ants like walking around the periphery, like like the cuckoos, like they lost their marbles. Like it's right there, right? Like the candy's right there. Why are you way out here? But there's always and the guy was saying there's like 7% of the ants will just wander. And the reason being is if you think about it from an evolutionary standpoint, if 100% of the ants were focused on the candy, then who's going to go find the next candy? So I thought that was fascinating, right? So you got 93% of the ants swarming on the candy, biting it all, taking it back to the colony. And you got 7% that's wandering around the periphery looking for new candy, looking for new things to bring back and say, "Hey, I found this other thing. Let's do this too." I never thought of that, but it's a great framework to think about life, right? There's a lot of people that are like the doers. They're in there doing stuff. And then you got these entrepreneurs that are out there doing crazy stuff. Like, I'm going to start this business. I'm going to send a rocket ship to Mars. Like, yeah, good luck, buddy. Like, good luck doing that. Like, I think NASA's got that monopoly. But Elon, he's doing it. Like he's on the way to doing that. And what's the quote? What's the Steve Jobs quote? Like there's some famous quote that's like the one percenters, the crazy ones, the unemployables, but everyone wants to change the world, but these are the ones that actually will. And that's really what it comes down to. It doesn't make them better. It's just that because they don't all succeed, right? There's a lot of them that don't succeed. There's a lot of them that flame out or get burnt out or whatever. But you don't win big unless you take big chances. But you can't take chances that will submarine your whole life. And that is not the lesson I'm trying to, I think Phil and I, neither one of us are saying you should put all your money on red and roll the dice. No, I'm not saying that. But what I am saying is that, if you're wired for that, take risks, especially when you're younger. The best time to take risks is when you're younger because you have nothing to lose. Go start a business. You have absolutely nothing to lose. And a lot of people think, well, I know, but I need more knowledge. I need more wisdom. I don't want to fail because then people see me as a failure. No, they won't. If you go to Silicon Valley, they look at that as a badge of honor. The quicker you fail, the more lessons you learn. So when you go to talk to a VC in the second time, they're like, okay, you failed. What lessons did you learn from that? And they want to see if you're smart. Because if you're just like, oh, it was somebody else's fault, you're never going to get any money. But if you say, you know what? Here's what I learned. I messed up. I did this, and this wrong. That's not going to happen again. I learned from it. Here's what I'm going to do better next time. VCs will pile money on you. They love that. They're like, you're the kind of person we're looking for. You're smart. You're a learner. You're mindful of that it's not somebody else's fault, that you're taking ownership. And 3, 4, I mean, they'll keep throwing money at you. I mean, and look at what's that clown's name that did WeWork, and now he's doing something else, and people just don't mind throwing gobs of money over him, even though, in my opinion, and I'm not slandering, this is my opinion, I think he's borderline of fraud. But the idea was interesting, but I think the way it was done was a little bit questionable. But anyway, so the point being is, they love throwing money at people because they're like, all right, they learned their lesson. What are they going to do different this time? So, I don't know what your thoughts are, Phil, but that's I think it's a good lesson for people to learn if you're looking to start a business. Is don't be afraid to take risks when you're young, because you're only young once. I can't afford to take big risks now that I'm older because I've got a family and obligations, and I can't, like, I can't put my family in jeopardy. So my wife doesn't. She's not my sugar mama. If she was, I could go and take big risks. But like most people, we got two couple working families. So anyway, so I don't know if you have thoughts, Phil. We'll get into the last topic of investment style. So
I will tell you that our experiences as far as that goes were different. I did start my career working for large firms. I whittled my way down and whittled my way down. And I did start my business. I wasn't that young when I started, but fortunately I had some money put away so that I could, my family and I could get by as I tried to build it. And I remember like I've talked to people about starting an advisory business because that's what I know, right? And I'm like, yeah, year one, it sucked. Year two wasn't much better. And then I've heard I'm not the only one that's had this experience, but it was when I got to that third year that I knew that I was building a business that was going to be able to do what I needed. And at the beginning of that year was when my wife said to me, it better work this year or you're going to have to go back to work for somebody else. And I'm like, yeah, that's not happening. And like now she's like, you can't ever go back to work for anybody else because once you've done that, I think it's very different. Like I've used the line that one of the reasons I started my own business was because I got tired of working for idiots. So I decided to be the idiot and start my own because it takes a lot. Like it's not simple. It's not an easy thing. And not everybody, like you said, not everybody's wired for it. It's different. But it's nice. I like the fact that I can make the decisions. I like that. And what we're doing, what you and I do, Kirk, is very different than some of the other things you're talking about. Like those people are taking really big risks and they're trying to do all kinds of different things. If you look at like the tech companies and the biotechs and all that, like that's where they're really going out there and trying to do very different things. And you're right. I've heard the same thing that you have about if you had a startup and you failed that can make you more attractive to a VC because, like you said, there's lessons that you can learn
Yeah.
from that experience, right? You don't know. Like even me, like I know I had a business coach, and like I'm an accountant, so I know how to keep books, but I don't know how to market. And so you have to also understand where your strengths and weaknesses are. That's part of having a business too.
Yeah. Well, as we kind of wrap it up here, kind of final question here is, I know we're talking about some, entrepreneurial stuff. It's not for everybody, and I don't think everybody should do it. I think you have to do it if you're wired for it. But, um, one part of this is like, what do you believe? Like, what's your investing style? Because one of the things Eric talked about, he said he's a passive guy, but he does some private stuff. Um, I don't think private stuff's for everybody, right? I don't think it's for me. I think there's a whole nother skill set that a lot of people have that are good at this stuff. Like um, if you're a good chairman of the board, like if you're good like board of advisors for companies, it's probably a good skill set for you to do this. I'm a better craftsman. I'm better in the weeds doing the work. I'm not a let me go buy 100 businesses and scale them up and do all the processes. Like that's a different skill set. And I appreciate people who have it. It's not me. I could probably build it, but it doesn't give me energy. It actually sucks energy from me, so it's not the life I'm gonna have. But it is an interesting thing. Like, what are the skill sets and how should you invest? One of the things we talk about in the show is invest in what you know. So if you're an expert in mining, then you shouldn't be investing in tech companies. If you're a tech entrepreneur, you shouldn't go buy, diamonds in West Africa, where I don't know where the crazy conflict diamonds come from. But anyway, like you should stick within your knitting and do more of what you know because um we had Doug Casey on the show years ago and great interview. I loved it. Most people think he's cuckoo, but I think he's very brilliant and he's a different flair than most people are used to. And one of the things that he had mentioned before and I think is you know, I think about for if you're like a lot of people what they'll do is they'll become an expert in something and then they'll retire. So like for instance Eric knows the shaving business, right? And then I'm not saying he does this, like it's not my point, but like somebody like that, he has a very specific need. And then he goes takes his money and goes invests in index funds. Or he takes his money and he puts it into tech stocks. I'm not saying he does this, but like a lot of people will do that. Like, oh, I got to diversify. Like, well, first of all, shaving, you should put all your money into shaving companies, right? Like if you're a real estate investor, don't put your 401k money into tech stocks because you don't know them. Figure out what you know about real estate and take advantage of your edge, right? Now, diversification has its place, obviously, but I've seen a lot of successful people, and here's a key that I've heard from a lot of successful people. Here's what they'll tell you is they become successful because they put all their eggs in one basket. When they have that basket, they diversify to keep that basket. Now, what most investors do is they diversify to keep it, which means it doesn't grow as much. And so there's always this balance of how concentrated should you be? So I'm in favor. If somebody's a real estate expert, put your money in real estate. Like, why would I tell you to put it in tech stocks? Like, I know some of this stuff, but like you have, like I've seen people get like 35% rates of return on like triple net property with just like zero maintenance. Like it's crazy, but it's what they know. Now I don't have this. By the way, don't call me and say I want that. No, it's like a specific deal that this guy had because he knows his market and he found it and all this stuff, and it's a great deal. But like that's not for everybody. Like I couldn't do that. I'd be lucky if I found 1% in Massachusetts. Mass is crazy. So, but what Doug Casey talked about was like he's like it's shameful that these experts um go do other things. Is what they should do is go start something else in that industry, solve another problem. Like you're obviously good at solving problems for people that people need help with. Go do that again. The world needs more good entrepreneurs. It doesn't need the good entrepreneurs to go retire in their heyday because you have enough money. Like go do something else. Like do if you're changing the world, go keep changing the world. The world needs a lot of change. So what do you think, Phil? Like what do you think for investing styles? Like how should people look at stuff like this?
So I really like the idea of investing what you know. And I can think of examples where we're supposed to diversify, right? And I remember when I was working for the other advisor, I picked the stock one time because I thought I understood it. And then earnings came out and they missed and the stock went down. And I was looking at what happened. I looked, I really don't know this company well enough to invest. And it's better for us to get out than to sit there and try and make money on something that we really don't understand. Because when you understand, at least it gives you more insight. And I like that idea if I was successful in something to stick with that. But it's true when you find a business, like people that don't diversify at the start, they are the data will tell you that they're the ones that end up being the most successful most of the time. Because if you can do something really well and you put your eggs in that basket, you do really well, you can end up doing better than somebody that diversifies. But if you don't know, it's better to diversify and settle for a lower return than to try to put all your eggs in a basket that you really have no chance of knowing if you're right or wrong. It's the same as going to the casino, like you said, and putting it all on red.
Yeah. Well, we're gonna wrap it up here in the interest of time. So Phil, take us home. Where can people find more about you?
So I'm Phil Weiss. My firm is Surprise Wealth Management. I know that experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. As I said, my firm's Surprise Wealth Management. We'd love to get to know you. You can visit our website, which is apprisewealth.com. That's APPRISE wealth.com. And if you add a /5-things to that, you can download a free copy of 5 Things Every Woman Should Know About Finances. Thanks for having me today, Kirk. Enjoyed the conversation.
Yeah, thanks for coming on, Phil.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.